that.
I like cybersecurity. Cybersecurity is definitely one of the most underrated parts of the SaaS business. The only thing I would say is that there's a lot of competition. So you just have to make sure that the technology is proven. There's one thing I have to take a deep dive into Fortinet because I think they have a hardware component in it also that's actually very promising. So I'll take a look. Yeah, I'll have to take a look, more of a look on Fortinet. It's I in particular, if I had to rank Fortinet versus some of the other ones, I'd say CrowdStrike would be at the top of the list in terms of just crazy level of adoption. Like my organization, we use CrowdStrike for endpoint security, Palo Alto networks, and I think Fortinet actually compete. But like I said, I'm not 100% very well versed in the cybersecurity SaaS space. One of my friends who's also on the Discord for the Patreon group, Sam, he's more on that side of the aisle. So like I said, I'll probably talk to him about it and let him kind of explain what the value is for each one. There's also Sentinel One as well. But I like the numbers with Fortinet. When you and Amit were talking about it today, I was just like, wow, that's ridiculously cheap when you compare it to the valuations that the other guys have been willing to pay for. So
Yeah,
it's just interesting.
and the way that I look at it is I couldn't tell you which one is better. That's just not what I do. I'm just looking at pure numbers base, and Cisco is willing to pay 28 billion to acquire Splunk, which is occurring in Q3, I believe, and they generate 850 million in free cash flow. Fortinet generates over 2 billion and trades at 50% of the valuation. It's just, I don't know, with the growth and everything. I mean, I started a position today. I'm going to scale into it and maybe we make some money on it. We'll see.
Oh, yes. All right, everybody, welcome back to Cashflow Chronicles. It is another great day. We have Hot Chris, and we also have Stephen Fiorillo to chat with us about planning for 2024. So very excited about today. So we'll get back to you in just a second.
No.
The stock is going to go up, down, sideways, or in fucking circles. It's all a fugazi.
Sell it all.
Greed is good. Huge upside potential, upwards of $60,000.
Oh man. I'm glad that you took the booty shaking part out, because essentially the first one that Matt sent me, right, with the intro, he's like, yeah, man, I've got this intro, it's gonna be great. I'm like, okay, sure. And it was just a bunch of chicks shaking their booties with like dollar bills raining.
I have not heard that song from LL in so long.
Well, that's the Chris sent it to me, and I was like, I actually really like this, and so obviously I took the booty shaking from the music video, and obviously I'm taking these clips, and I'm like trying to make the clips work. But anyway, obviously when I did it originally, we got demonetized because it was too much LL Cool J. So I had to like weave LL Cool J in and out. So it's a little bit of fun. But Chris said he's got some things in the works. We'll see if he ever gets to it. He's a busy man, so I understand why he might not be able to get to it. But that's the intro for now. Hopefully everybody enjoys it.
That was kind of heroic.
Yeah, it was Chris's idea on LL Cool J, so I took it and ran with it. But anyway, emergency meeting, everybody. We're here to talk about what the hell we're going to do with 2024. It is way different than 2023. I'm talking to everybody. Everybody outperformed the market last year just by picking up a bunch of stupid stocks that probably should or maybe should not have been up 50, 70, 100, sometimes 250%. And I think 2024 is going to be a very different investing environment. That's why we have two of some of the best people that I know of on YouTube to talk about this sort of stuff. And that's Hot Chris and Stephen Fiorillo. So I'll hand it over to you guys, and I'm just going to shut up and listen and get an education from you guys.
I mean, look, there's always going to be opportunities in this market. All right. No matter where you go, there are opportunities. The key, though, is that you have to understand where we are in the market cycle sometimes, because with index investing now, a lot of people are just doing a lot of passive investing, which means that sometimes things can get overbought and oversold very quickly. And right now, I I'm bullish on certain themes, but I would say I'm being a lot more conservative with my capital, waiting for something to come down and then pick things up that are good quality. I know that are cash flowing, that can generate revenue, that can generate profits and substantially do buybacks, because buybacks are probably like one of the greatest things ever to happen to investing. So yeah, I'm just keeping my eye on a lot of great companies that have a lot of growth potential ahead of them. But I'm stockpiling cash right now just to weigh out this turbulent January, February. By the way, I don't know if you know this, but if you look at the Magnificent Seven, most of them are trading at or below their September highs. I don't. So technically, if you were buying in September, you're flat for the year for since then. I don't know if you guys noticed that, especially with the recent sell off. Yeah, yeah.
Matt, you're on mute.
Yeah.
Well, I was waiting for you to hop in there, Hot Steven.
I think a lot of people are going to be surprised. I think the market is anticipating too many cuts.
Mm-hmm.
I said throughout all of 2023, the Fed's not cutting. And guess what? The Fed didn't cut. People did not take Powell seriously. Powell comes out a little bit more dovish than I thought he was going to be. And all of a sudden, I started looking at the Fed Watch tool, and it changes every day. So let's bring it up right now and see where we're at, because this is looking kind of crazy. Let me share my screen.
Yeah, and that's one thing I've been talking about while you're bringing that up is like I've been very firm that I don't think March is the appropriate time. I think when it finally comes out and the notes for the January meeting or even the other meetings come out in the future, just like we kind of saw, which is what's driving a little bit of this push down in the first few days of the year. I think it's going to get even worse as people recognize that March is probably an unlikely time where we're going to get cuts. I'd be very surprised if
This
by March
just
time we're getting
changed
cuts.
from yesterday. This was not at 100% for the January meeting yesterday. And I think I have a screenshot in one of the articles I wrote yesterday, the day before. We go to March. I mean, they're really still expecting a big cut. You go to June, pretty much nobody's expecting rates to be where they are now with an overabundance under a 5 handle. And this is still crazy to me that Powell comes out and says the assessment of the Fed members is a median of 4.6% in 2024 to close, 3.6% in 2025, and 2.9% in 2026. This is what the Fed Watch tool is pricing into the market right now to close out 2024, with an overwhelming percentage of it being 375 to 425 bips. I mean, the market is not listening to what they are saying at all.
Yeah, they're fighting the Fed. The market is definitely fighting the Fed. But a lot of that is because of the comments that Powell made, which, by the way, I think he realized he flubbed up on. And then so you had Waller and
They tried walking it back.
They tried walking it back, but it was too late. The door was already kicked wide open for the speculation. So I think to some degree, Powell is going to have to own it a little bit and just kind of just say, hey, listen, we're data dependent. By the way, I don't know if you've been tracking the Cleveland Fed Nowcast for December. It's actually hot, so you got 3.3. If we get a 3.3 handle in December, that's not going to be good, because that's just going to reverse all the gains that we just made in terms of like the deflationary narrative. So I'd say we have to be very careful. The labor market is still holding up really strong, and that's another thing to worry about as well. So, it's just right now is a good time to apply caution rather than trying to take bets on things that might have already run up so much. And I think 2023 we had a lot of running up, so some of that valuation drag is going to have to catch up. And then also wait for earnings. Earnings are going to be very telling as to what's
going
going
next
on.
week.
Yep.
I mean, look, I'm buying, but I'm always buying. That's nothing new. And I have a little bit of a different plan that I'm going to deviate toward this year. I do think they're going to cut rates. I think too many people are making too big of a deal about the election cycle, and they're trying to read too much into it and saying, oh, they're going to try to prop up the economy's propped up already. Like the economy doesn't need to be propped up any more than it already is. The biggest thing about rate cuts, enough with the economy and everything else, debt maturing and carrying cost on credit cards and loans. You need rates lower. And I'm sick of hearing people talk about, well, you're at an average over the past 4 decades. I got news for everybody. You didn't come off no rates. Like, that's the big thing. We've never been in a time where you had rates at basically nothing. And then companies borrowing and then having to refinance at rates that are so much higher that may not work in the profit model. So, I mean,
there's a lot of companies out there that only make a 10 to 15% profit margin, right? So when you start eating away,
even less,
some less,
I just want to see 3 cuts. So if the Fed just sticks to what they say, things will be fine, because in 2025, it'll come down to 3.6. Refinancing will be fine. And quite honestly, even if the market goes down, I'm happy because I'm still going to buy. I mean, I do think that you're going to get a broad market rally. I still believe that. I think people are going to take profits from the Magnificent Seven. I think that's going to get redeployed into income producing assets because there is less of a reason to stay in risk-free assets when the Fed is cutting rates. I think they're going to move toward stocks like Verizon that has over a decade worth of annualized dividend increases, because not only are you going to get a bigger yield than you were getting risk-free to take on risk, but you're getting an annualized raise every year. And I think that's what people are going to look for. And
if you look at it, Verizon has consistently raised their dividend 2.5 basis points every single year for the last 17
years.
18 years. So it's crazy. And not to mention, if you look at how much of their free cash flow, they have a ton of free cash flow, which they can use to pay down debt, keep paying the dividend. So a lot of people were saying, well, you know what, Verizon's going to have to cut their dividend. I'm like, bro, you clearly don't know Verizon's business model. And if you do a little bit of homework, you can see that they've actually guided for much, much lower CapEx for the next 2 years, which means that all of that additional CapEx savings is going to go right back into the bottom line, and they're going to use that to basically pay down debt. Once they pay down debt, their credit rating improves, right? And this is under the guise that they don't actually grow that much, which I think is a completely false narrative. I think Verizon, T-Mobile, and AT&T are on this giant growth vector with fixed wireless access and 5G starting to kind of make a big presence in the technology space. So I'd say these are no-brainers. Like Verizon is a no-brainer. If you want a long-term appreciating stock and also have dividends coming in, just buy some stock in Verizon and chill. Same thing with AT&T.
I think prudent companies took the opportunity when they had it to some overdid it. But what I'm talking about is when we had the zero interest rate, a lot of companies took the opportunity to say, hey, we have cheap money today. We can invest this, get a 20% ROI on whatever we put into the market and be able to pay it back over time. And as long as that's not a declining revenue stream, they had the opportunity to put themselves into a good position. I think Verizon's in that camp. I think NextEra Energy will be in that camp. I think there's a lot of great companies with great management that saw this opportunity coming. And that's why I think over 2020 and 2021, there were so many people that took on so much debt in those years, is to be able to get to that last point. Now, I think with that, you're going to see a lot of companies lowering their CapEx going into 24, 25, and 26, and then being able to live off the fruits of their labor and investments that they did from 2020 to 2023 and print a lot of money. Not every company will be able to do that, though. So I just want to state that explicitly. And then there were some really good mentions in the chat, specifically from June. And I agree with what a lot of June put here with respect to her talking about how we were going to go higher and for longer. And that's what Powell's kind of been saying. And that is, if you look at the last year of the SPY, the whole seesawing effect that we had throughout the entirety of the year, right? Because everyone was like, okay, we're getting closer and closer. In the first half of the year, we're getting closer and closer to a place where we're going to start to cut rates. Then it got to the middle of the year, and then everyone said, well, maybe rate cuts won't happen until 2024. That's when he started to see it seesaw and go back down. And then towards the latter half of the year, we started getting some positive notations coming out of the Fed. And that's what drove that last month and a half rally from the end of October until basically the beginning of January, where we went on that 10, 15% run, right? And I think that had a lot to do with it. And I think we're about to hit another one where people finally realize we're probably not getting a rate cut in March, and we're going to pull back again. And then as soon as we get through March, everyone's going to be like, okay, well, maybe it's going to happen in the middle of the summer. And then you're going to seesaw back upwards. So I think we're not out of this volatility period as of yet. But I'm curious what Chris's thoughts are, because I see he's smirking, and I don't know what he's smirking about.
I'm actually just looking at the comment section. Like Verizon, the thing is, Verizon's debt, you really have to dig into it. But they do have a lot of debt. They're the third most indebted company, I think, in the S&P 500 right now. So I'm not disagreeing on the debt part, but you have to remember that all debt, depending on the company's cash flows, is manageable. If you look at the total cost of debt for them versus their free cash flow that they're generating, the debt is not their problem. Their biggest issue would actually come from churn rather than debt, which, by the way, they're improving a lot. So I would say that Verizon's fine. Like, I get it. I'm not disagreeing with anyone, but I think a lot of that debt is already baked into the share price declining. And as they work that debt down, that also just means that the stock price will go up, because now your liabilities are shrinking and your assets, which you bought, which, by the way, go into like the next 2 decades, which amortizes very slowly, is going to be a big thing. So.
Yeah, I mean, Chris and I could spend a half an hour dissecting it for everybody if they want us to do a separate segment on it. But the two things to look at, in addition to free cash flow, look at their earnings from continuing operations. In the trailing 12, it's $21.37 billion. Okay. Then go to the 10K and look at the actual debt schedule. And then look at their balance sheet, because on their balance sheet, they currently have $4.3 billion in cash on hand. That does not include long-term investments or anything else. And then you can model out between their cash on hand and then what they pay in a dividend from their earnings from continuing operations and what is left over, if the debt is manageable. I've done it. Chris has done it. The debt is manageable if they do it the way that I've projected out. So that's why I'm not worried about their debt. But something about the market with the SPY, I think a lot of people seem to forget that we live in a much different world right now, in a much different time. I know the two of you have been investing for a long time. You did not have this type of market participation 10 years ago. You did not have this type of market participation 20 years ago. And I think something that a lot of people forget is we've moved away from a system where companies offer pension plans. A lot of it is privatized 401ks. And the most common assets in those types of retirement accounts are either target-based funds or S&P/total market funds. So when you think about the amount of people that are buying into those funds on a bi-monthly basis, and then you look at the access to the markets at $0 trades and everybody being able to invest from their phone, it's a much different animal now. And you still have $6 trillion on the sidelines, and there could be a significant portion of that coming into the market because there's less reason to stay on the sidelines. And that doesn't include, and Chris was a little annoyed when I told him I had a CD ladder built, but I have my own reasons for it. And I'm much more complex investor than a lot of people, but the money that you're seeing on the St. Louis Fed and money market accounts does not include anything in T-bills or CDs. And a lot of people have maturity ladders that were built out either on a 12-month cycle or a 24-month cycle. And when that money starts terming, it could flow back in. And remember, money that's in money markets is not serious money about yield. Because if it was, they would have taken the 2-year over 5% or the 10-year at around 5%. So they're just using it as a proxy. So there's a good chance that a lot of capital is flowing back in the next 6 months. And that's why I think you're going to get a broad market rally no matter what the Fed does at this point. because I don't think they're going higher. And if they do go higher, it's for 2 months and then they're going to cut. That's the only way you get a rate cut in March at this point, I think, is if they unexpectedly increase rates in January. I think
Just
you
to
get 2
shock,
months of
just to
that,
shock people.
just to shock it and get it out of the way.
The reason why I'm annoyed at I would say annoyed. The reason why I would say I was a little bit disheartened to see that CD ladder is because the yield on those CDs is a lot less than what you could get in the open market. And someone who's
How much we talking? How much we talking?
No comment.
Because I wrote one CD, and it was because I knew I was going to be. I just wanted to trial it with Infidelity, and it was a 5.5% CD for 6 months or something like that, or maybe it was a 5%. I forget what exactly it was, but yeah,
I gotta talk to my father-in-law. I think he's got a CD ladder too right now. And I mean, he's retired, so he definitely needs to be in a lot more like secure stuff. But you know, there's just so much opportunity out there. Maybe taking a portion of it and putting it into something that can yield a lot more right now, which has a lot of security inbuilt, could be a good way to generate additional income. You know,
Chris, if you had to, and Matt, if you had to pick which of the Magnificent Seven are going to do the best and which are going to do the worst, what would they be? And I'll tell you what mine are. I would say Alphabet, Meta do the best. NVIDIA sells off hard. Tesla and Amazon, middle of the road. Apple kind of flatlines, and I'm up in the air on Microsoft.
I agree with that list, with the exception of I would put Meta a little bit on the back burner. So I'd say Google is at the top just because their valuation is absolutely just crazy low right now. Number 2, I would say, is Amazon, believe it or not, because they're generating just so much free cash flow. It's like, I mean, it's the same story.
I think there hasn't been a trailing 12 months where they've actually worked on their efficiency, and I feel like you're about to see it.
I'm going to shock you, Chris.
Okay, I'd love to see it.
Look at the valuation of Meta and Alphabet as of today. They are trading at basically the same PEs on a forward basis. How crazy is that?
That is pretty crazy.
Not, yeah.
I didn't realize that Meta had that much growth, but I knew Alphabet did because I studied.
Well, no. So Meta, the thing with Meta is that Zuckerberg, he did not cut slight. He cut deep. So that means that he's saving a lot of money. And the thing with Zuckerberg is that he's always known to be running a very, very like capital light business, right? So you're going to have a ton of free cash flow that they're going to be able to take that right into doing a lot of, which means that they can take that and basically pile it right back into buybacks. You know, so yeah, I agree. Meta's good too, but I'd say Steve, Amazon is the one that really is being underappreciated right now. I think
it was very strategic why Bezos left the time he did. I think he said, you know what, it's grown to a place now where they can focus on maybe not growing as quickly as they need to and start focusing a little bit on playing the 50-50 profitability game. And I think that you're going to see a lot of that going forward where they're balancing the growth aspect of things. It was Amazon, I think everyone's used to them having a low free cash flow at the moment because they were so focused on growing 50% year over year. You think it's not like software. It's not like Google where it's like easy. You used to think their 50% revenue growth. Yes, some of it was cloud, but when you're talking about warehouses and things of the like, that's very capital intensive. And so when it gets to being, you know, a very capital intensive business and being able to sustain that, not only even after the pandemic, but to keep revenue flat, if not continuing to grow after e-commerce kind of rolled over and is now starting to get back to growth, I think you're going to see Amazon really within the next 12 to 18 months kick it into third or fourth gear. And they're going to focus on efficiency with that, as they've already started to do over the past 12 months. And it's really going to shine through. Meta, I don't necessarily know where I would put that. Apple always scares me, but obviously that's lost me a lot in terms of opportunity cost because I've never been a huge investor in Apple other than through my investments in the S&P. But the thing that scares me is you're in a 30s PE with not a very fast growing revenue stream. Microsoft is growing just gangbusters. So I feel like that's going to continue to be middle of the road. Nvidia, I feel like that's a wild card because I feel like they've been able to grow so quickly over the past few quarters. How can they sustain that? I don't know. And that's where I'm kind of scratching my head.
I'm worried about Nvidia for the simple fact that you have Amazon and Google and Meta and even Apple making their own chips. And Apple's become huge at it, by the way. I think people underestimate how advanced they become with chip manufacturing and their design. And it's an election year, and there's only two places to allocate advertising dollars to. It's called freaking Meta and Alphabet. That's why I think they're going to do really well this year. Amazon, I've been critical of. I'm back to very bullish. I'm a long-term shareholder. It's going to do very well this year, I think. And the big problem was inflation, supply chains. I mean, you really go through the numbers. There was a period where they were having some very serious problem, and AWS was their only reason that they were profitable still. But yeah, I agree. Apple needs to be on the VR train. Like, I think that that's the next growth sector, and it could be 2 or 3 years to play out.
So this is Amazon's operating income. So you see this giant bump up, but this is TTM. Look at it on a quarterly basis. Last quarter, not even like the December quarter, which is usually their strongest quarter, they generated more operating income than they did in 2021 at the height when Amazon
input costs came down.
Yeah, because they stopped spending so much on CapEx, and rather now they shifted their business model to doing a lot more third-party selling and a lot more advertising on top of their already burgeoning AWS business, which is still growing considerably. So they're generating so much cash right now, and it's going to CAGR like crazy. I think the December numbers are just going to shock people on how much operating income is being generated, and I would not be surprised if Amazon goes into buyback mode after this, because I mean, at this point,
nobody is not going to pay $3 a month to not have ads on Prime. Like, everyone is not going to pay that. I'm going to pay it. I mean, I watch Prime all the time. Trust me, for $3, I'm not dealing with commercials on Reacher. Sorry, not happening.
Yep. Amazon's got such a wide. The other thing is to try to disrupt Amazon because they're just so. Good luck. I mean,
good luck. It would do it.
It would take you 20 to 30 years to try to disrupt Amazon. You know,
they're just disrupting a company that spends $64 billion a year on CapEx for the past 2 years. That is more than Microsoft, Walmart, FedEx, Target, and I think UPS combined. I mean, you can't rebuild their infrastructure. It's just not going to happen.
Yeah. I was driving throughout the Southeast and like from New York back to Georgia. Let me tell you, every exit you see these giant Amazon warehouses, you know, all over.
What the hell just happened? Oh.
No, he just made me disappear for like 2 seconds. But yeah, man, it's just this Apple. Yeah.
I mean, even if Apple isn't growing their revenue, and they've had 2 consecutive years over the past 6 or 7 years where their revenue declined by about 2%. It's a company that has bought back $630 billion of shares since 2012. I mean, it is insane. They buy back more than $1.5 billion a week in shares. They will manufacture earnings. Show me another company that has returned almost $1 trillion in the past 11 years to share.
So I can't show you a company that has done that, but I will show you a company that is doing something
Alphabet.
very similar.
I know you're going to say Alphabet.
Look at this.
Yeah,
They only started doing real buybacks in 2019. This year they accelerated it like crazy, dude. So I mean, they're doing about 70 to 80 billion dollars in share buybacks right now, which means they're doing about 15 billion, I think almost 16 billion per quarter in just share buybacks. All right.
Yep.
And on top of it, Google, unlike Apple, is still growing its top line and bottom line. So what does that tell you?
And I think there's a lot of growth for Alphabet. I think there's a lot of growth ahead.
Yeah. I think easily they get to, by 2026, easily between $9 and $10 of EPS. And if you think about it, Google at that multiple traditionally has been around 25. at an 8, which is conservative, you're looking at about a $200 stock price, right? And if you're looking at it a little bit on the higher side of things, with maybe a 10 earnings and maybe the same thing, you're looking at $250 stock. So,
Which means if you're thinking about it, everybody that's listening, if you're buying it today at $140 and it will be trading at, say, $8.50, $9 EPS, you're basically buying it at a 15x PE for the next 2 to 3 years, right? It'll have to grow into that valuation of the 25x, right? Once it kind of gets to the place where it's $200, $225 a share. But buying it today in that future $8, $9 PE, that's what you're kind of looking at. Do you think it's actually going to get there? The buybacks, the actual growth of the business? That's where I'm kind of sitting here being like, it's stupid not to be buying Google. Yes, will there be some volatility? Sure, maybe it'll go back down to $120, $115, $110. But to me, that's a great opportunity to pick it up, and hopefully it goes back up to all-time highs, and you're sitting here and say 2-3 years looking like a goddamn genius, just like when I was picking it up in the 80s, just in 2022, less than 18 months ago.
Let me show you guys something also very interesting. So I keep a track of all the big investors, right? To see like, what are they buying? What are they holding on to? This is one of their biggest positions. So these are the companies that are most owned by big time investors. Okay. You're talking about like the hedge fund guys like Bill Ackman and everyone else. Number 1 at the list is Google. Number 2 is Microsoft, but number 3 is Google, the voting ones. But you can see here as the most owned stocks, Google just ranks right at the top of the list, man. Same thing over here on a percentage basis. Google's right there. So I don't think you're going to go wrong with Google,
Interesting. Steven, I want to get your thoughts. So I know you've been writing a lot about Seeking Alpha. We put those articles in the description for anybody that's interested. You have 2 that you brought up within the past week. One about realty income, and I know that's a heated topic amongst me and Chris because I've sold out of realty income in the recent past, and I know Chris also looks at it kind of with a confused puppy look as well as to why people love it so much. So I would love to get a little bit more thoughts as to why you like it so much. And then there was a second one, which was a closed-end fund. Which one was that one again, Steven?
PDI. Have you looked at it?
I have not.
Bring it up. It's up significantly. I don't remember when I told you guys about it, but I think it was in the 16s. I don't think I told you about it in the 15s. I think I told you about it in the 16s.
What ticker was it, sir?
P is in Peter, D is in David, I is in Igloo.
Let me tell you, before you do that, I'll show you the reason why I'm not the biggest fan of realty income. And maybe you can blow holes through it if you want, Steven. But if you look at this, right?
Please don't. Please don't.
Please don't what?
Just whatever you're going to say, just please don't, because I'm going to blow holes right through it.
That's fine, but
I know what you're going to say. Walgreens, AMC, blah, 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 blah. I know you're going to say.
Exactly.
I know.
That's all that really concerns me, dude. That's it. And the thing is, like, this is a marginal business. So if you think about it, any issues that happen to Walgreens or even Dollar General closures or Regal or AMC closures could mean that these guys end up having a ton of buildings that are not being leased out, because these are very like specific type of assets, right? Like, I'll give you an example. There is a Rite Aid about 2 blocks away from where I live right now. It's been sitting empty for the last like almost 1.5 to 2 years. I am going to find it really hard pressed for a lot of these older stores to be able to be rented out again, which means that they're just going to be sitting there not getting rent, All
right. So we're going to have to spend a lot of time on this. So before we go into realty income, PDI, Chris and I talked about corporate debt because we both invested in some vehicle. And I don't do as much due diligence as Chris does on the individual assets like that. I think PIMCO is one of the best asset managers in that space. So there's three funds that I really like. PDI is the one that I really like for corporate debt and fixed income. And I'm doing very well on it. It's got a 14.5% yield. And my investment thesis is pretty easy. As rates come down over the next couple of years, new debt will be issued with much lower coupons, making existing debt much more attractive and go up in value. And I think that you're going to see this go back into the mid 20s over the next couple of years. It's going to take some time, but I am fine getting paid a monthly distribution and getting a 15 or 14% annualized yield and just sitting back, reinvesting it, and just going. I mean, if you do a long-term chart of where it was before the inflation and rate hikes happened, do a 5-year chart. I mean, it's just, even if it doesn't go back to pre-pandemic level, even if it goes back to where it was in 2021, I mean, I'm going to be fine on it. That's just me.
I like this, but I'll take a second look at what they're holding, because that's always the thing that trips me up is when you have this kind of yield. It's like, what kind of risk are they taking on, and like what kind of debt are they buying up? So like let's take a look real quick. So this is the thing.
1,800 individual assets. So it's a lot of diversification.
Right. No, that's great. I love that part. Whenever you're looking at any income producing assets, that's one of the things. But 27% of it is coming from mortgage, which is, well, and the other thing is it's non-agency backed. That's the other, not the greatest thing. And then high yield is about 20%. And then CMBS, which by the way is, I mean, I don't know. I think I could, come on, Steven, me and you could do a better job picking up stuff ourselves, man. I could buy a lot of this debt myself and get a better yield, than trusting these guys.
The difference is I don't have to expend any energy and I'm getting a 14.5% yield.
That's a good point.
The amount of due diligence I would have to do would take away from other stuff that I think I would make more money on.
Yeah.
That's my only problem. And that's why I like the PIMCO funds, because look, it's not a huge part of my income producing, but I don't have exposure to it anywhere else. So for me, liking the diversification of a well-rounded portfolio, it fills a hole for me. And that's why I like it.
Yeah. I mean, to me, I'd have to look at the entire portfolio and what they have, look at what the true value of everything is, and then what is it trading at and how much of a discount they're getting. Because with a 14% yield, that means that they have a ton of corporate debt and a lot of debt that they bought at significantly lower prices than they're trading at right now. All right, fuck it, man. I'll just do my research and I'll let you know. Yeah, but it does look good. Okay. It does look good. I'll take a look.
Yeah. Oh, and the distributions get reinvested at a 5% discount.
What's the taxable? What's taxes on it? Is it what do they issue? Is it just income? No, what is it? Is it just ordinary income as it goes?
Yeah, it's 1099, I believe.
That's good. That's good. Yeah.
And then I saw you wrote an article about this one. What makes you think this is a good opportunity for 2024?
Oh, RQI, because I think REITs are going to do well. It's instead, I don't particularly like the Vanguard VNQ. It's too low.
VNQ has a lot of crappy companies in it.
This one happens to have Realty Income and Simon Property Group, which is one of my favorite REITs. And in the top 10, I like Cohen and Steers. They are very good asset allocators. And it's a leveraged fund. The leverage is around 30%. But if you look at the historical distribution, I think it's 22 or 23 years of distributions ongoing. I mean, it's just a way to get all of the REITs that I want in one place and have people that look at this every day sell cover calls against it to give me a little bit of extra yield. So it's just work I don't have to do, even though I own a bunch of the stuff individually anyway.
Yeah, I have a few REITs as well, but I'm being a lot more concentrated rather than trying to find a fund. But I mean, Steven knows, man. Steven and me, we did a great job on SLG. Do you have any Vornado? Do you still have any?
I still have some Vornado, yes.
Do you know if they restarted the distributions or no?
Yeah, I got it. Pretty sure I got it in my account a couple weeks ago.
Because I know they had paused it for a little bit.
No, they reinstituted it.
Yeah.
Yeah,
But
I mean, look, there's
were,
a lot of REITs I like. And individually, my largest REITs are SL Green, Starwood Property Management. I can't say enough good
Barry
things about
Sternlicht.
Starwood. Barry Sternlicht is a stud. To me, he's the best real estate CEO in the game. I listen to everything he says whenever he's on.
He's also very connected,
He's awesome. Simon Property Group, I have loved that company for a long time. Look, malls are not going away. Class A malls are not going away.
Yep.
They are a fabric to the community. It's not just shopping. It's experiences. It's dinner. It's movies. It's mini golf. It's everything under the sun. And you look at Class A malls, it's something that's never going to go out of style. So Simon
and they're also especially with like something like Simon Property, they're all located in city centers.
Dude,
so you're not talking about
Mall. I'm sorry. Like if anybody lives in New York, go to Roosevelt Field Mall and tell me that you think that that's in trouble.
Yeah. I grew up right down the road from the King of Prussia Mall outside of Philadelphia, and that thing is always buzzing. And that got bought many moons ago about Simon Property Group. The Galleria here in Houston is run by Simon Property Group. When they buy a mall, it's in premier locations. Hell, when we went to the Aria for Amit's birthday, that was the outside and mall area for that was run by Simon Property Group as well. They buy premier properties. They're not buying out in like the boonies and the sticks, where all the malls are shutting down,
And I think that's the key important thing when it comes to REITs, right? You have to look at the assets that are underlying the securities that you're buying. You can't just say, okay, yeah, I'm just going to buy this REIT. Like, no, where's your REIT? What are you looking at? Like the good example is when I did DD on SL Green, and you remember this, Stephen, where they were having a fight with, I think, 425 Madison with the operating lease over what's his name, Ashkenazi. You remember that? And they were able to get that whole giant parcel, right, fully under themselves because they got into the mezzanine structure of the debt, and they were able to take them to court and take ownership over the both of those, and then go right back into it and then sell the operating lease at such a freaking amazing thing. Why? Because that property is an entire square block in New York City in freaking Billionaire Row. Even if you just tore the goddamn building down and built like a high-rise condominiums, easily that thing is worth $1 to $2 billion. So if you look at on the asset on what SL Green did, they completely wrote it off because of the whole court case. But the minute that thing got resolved, that was a giant asset that just got that they were able to liquefy and take that capital and pay down the debt. It was so freaking nice to see that. And that's the one thing I love about SL Green is that their management is just on another level. And they know New York City. They know New York City like it's the back of their hand. They've been operating in New York City for the last, God knows how many, I think 30, 40, almost 40 years,
So when Chris and I were discussing this, I was already invested, and you asked me why. And look, you live in New York, Manhattan. So my investment thesis was the pandemic changed the mindset of individuals, and people are accustomed to instant gratification more than ever. Nobody wants to get off a subway or a train in Grand Central or Penn Station and then take 2 more subways downtown and walk 10 minutes to the office, or take 2 or 3 subways uptown and walk to the office. Everybody wants to be somewhere in Midtown, whether it's Midtown, Midtown East, Midtown West. You're going to see a convergence in that area for Class A real estate. Also, as an incentive to get people back without complaining or jumping ship, people want to be in Class A buildings, not Class B, Class C. SL Green has, in my opinion, the best assets in that premier proximity to the major transportation hubs. And they have was an 89.8% occupancy rate, probably over 90% in 2 weeks when they announced the Q4 numbers. They have a very big pipeline that I believe, if I remember correctly, they said they would be at 92, 93% at some time in 2024.
Yeah.
This is a company that when you look at the deal that they did last year, they were in, it was 290 Madison. I always get the address mixed up, but they owned like 170 million in the preferred equity. They ended up buying the entire rest of the building. They were 2 billion all in.
Yep.
Almost exactly a year later, they sold a 49% interest to a Japanese firm at a $2 billion valuation. They sold it at the height of the regional banking scare for $2 billion. And it showed that they don't have to rewrite their asset values. They got the same price that they paid for it a year ago in a much friendlier operating environment. So that showed that the book value on the books was legit and it wasn't going to get re-rated. And at that time, it was like $63 a share when the stock was trading in the low 20s. I mean, even with that sale, the book value is around 58. I'm going to go to it right now and I'll tell you.
Yeah. But just while Steven does that, I'll just show you guys. So this is their projected occupancy, their leasing schedule that they're probably shooting for about 89.5% because they just have a lot of maturing expirations coming up. But for the most part, it's a very strong business. They're probably going to get back to 95% or higher soon enough. This is Class A real estate in Manhattan. Like this is Grand Central. Where's Grand Central? Grand Central is right around here, and they own all of that around the area. Like I'm talking about Class A buildings that are generating at the top of the rent schedule. All right.
Yeah.
Not
show,
like a bullshit.
Show one Vandy and show one Madison, please.
Yeah. I mean, let me see if they have right here, one Vanderbilt right there. Not to mention that not only do they own this whole thing, they own the goddamn rights to the whole thing. And they're generating $50 million in cash flow just from this top
the summit up on the top.
Yeah. If you guys see what it looks like up there, it is amazing, dude. Like it's, yeah, this, like I said, this is not a bullshit company. They make a ton of money. They have great relationships with every developer, every politician. Because that's the other thing too. In New York City, you cannot be in real estate without having your hands in the political arena. And if you look at the Eric's administration, the Adams administration, sorry, not the Eric's, they're very well connected to SL Green to the point where I think there was an address from the mayor from one of their buildings, you know, and they're in line to get one of those casino licenses, and they partnered with Caesars in Times Square. If that thing goes off, you're going to see SL Green go crazy in the next couple of years. So, and you're getting
so I'm glad you brought that up. I'm going to their presentation right now, and then I'll share my screen. But the book value of the company right now is $59.28. So Chris and I were buying in the 20s. It's still compared to book value under.
I got Matt in too. So I was like, I showed Matt. I was like, Matt, you need to take a look at this.
So
I just,
right. This is going to be wild. Now, before I share my screen, okay, I want everybody to understand something. I have no freaking clue what is going to happen. Okay, but it is a fact that New York has approved 3 downstate licenses for casino. And when I think about the players that are coming, so Chris, this is what I've seen. It is Steve Cohen and Hard Rock are trying to do something across from Citi Field where the old Shea Stadium was and revitalize that area. Las Vegas Sands is doing something at the Nassau Coliseum in Nassau County, and the renderings for that looks amazing. SL Green and Caesars for Times Square, and then I'm not sure, it could be Resorts World for the Aqueduct. Those are the 4 that I know of that they're trying to get through. Now there are 3 downstate licenses up for grabs. New York City is going to get one of those licenses, and you have to think it's going to be SL Green because of how politically connected they are. And especially since all of the submissions are going in this month or next month. Caesars and so share my screen, Matt. Caesars and SL Green is a powerhouse, and imagine if this comes to Times Square.
Yep. I was going to show him the exact same thing.
This is what sold me, by the way. When
Like-
Chris said, "Hey, we should probably think about this," I got to this and I was like, "This is a lie, right? There's no way."
No, this will revitalize that whole area, and it's not just the ground floor; it's the whole thing. The whole thing is going to be redone. All right, so here we go. RFA is January 3rd, first round. Yeah, so this is going to be very interesting to see, but this is a real possibility. Yeah, 3 downstate licenses for New York, Westchester, Long Island. I think you go 1 in each area. I can't think about who else would get a license in New York City over Caesars and SL Green, especially since Las Vegas Sands is going after the license in Long Island. Like, they're not going after the city. So, okay, here we go. So this is a new one. I haven't seen this. So yeah, Sands, the Coliseum, Steve Cohen, Hard Rock. There's a lot of proposals in the city. Wow.
Yeah.
None of these guys have a chance. None of them. Like, who is going to, I don't understand why these guys are even putting anything in. None of these guys have a chance against Caesars. I just don't see it. I think there's more pictures.
Yeah. There's one thing to just go on. If you keep going down that's actually good in this presentation. You see the liquidity that they have. They don't have a lot of debt for maturity. There you go. That's their debt maturities. So anyone that's worried about the debt,
They just paid off a ton of it.
Yeah,
Yeah.
huge. It was like what? I forget the number, but it was massive. It was a huge wall.
Yeah,
But they had to pay by
they
the
have
end of the
done
year.
a great job. And look, I'm a dividend fiend. I'm okay getting a little bit less of a dividend to clean up the balance sheet because they are now in a position, if other operators have to foreclose on assets or turn the keys back, they can scoop up other assets for pennies on the dollar if needed, or if they feel that there's an opportunity to. And look, this is a company, they have connections with the biggest and best contractors. They are better equipped than most people to convert if zoning laws change to apartments for unwanted office buildings. And that could happen in some of these other areas. You could see Class C buildings become housing.
Yeah.
Now, I mean, well, I'm a big fan of SL Green. It's my largest REIT, so big fan.
Makes it
So you want to do the realty income? You want to do it?
yeah, I
Maybe
want to.
we'll
I want to
save
hear
that.
Chris.
Save that.
I
Save it. We're at
All right.
11 o'clock. Save it for another episode, man.
All right.
Well, it's not. It's
gotta
not
get
fair to
people to come
us that
back.
you always. It's not fair to us that you always take 10 minutes on finance junkies. I gotta rip them a new one and make sure they don't keep going over on 10 p.m. time slot.
I mean, Chris, I told you that I started a position in Pfizer, right?
Yeah. I'm doing my own DD on it. My only concern is I want to look at Pfizer's pipeline to see like if they have anything major coming up or if there's any giant expirations on their cash flow generating ones, because I know that they have a few blockbusters that make up a significant portion of their profits. So I want to make sure that they have something either in the pipeline to replace it via a new version, or that they have other drugs that are coming to the market at the same time. Plus, I have to do some DD on their CGen acquisition. So yeah, I like the company, dude. They've been around for 100 years, so you know it's not a small company by any means. But they have a ton of cash. Yeah.
Also, looking at Bristol Miles also. I do not own a lot of it. Okay. I write a weekly dividend series on Seeking Alpha where I put $100 a week in because so many people think dividend investing can't work unless you put in a very large sum of money. It's bullshit. It can work.
Yeah.
You just need a lot of time and to keep investing. So I added to my position in Bristol Myers today because I noticed it's been going down. It's down 28% this year or over the past year Dividend yields 4.6%, and they've been going on an acquisition spree. So I add to my position in it.
It's a good question. What do you think about this question, Stephen? You
Yeah,
think there's still a
more
lot
upside.
more juice?
Yes.
Yeah.
Not
I agree.
tomorrow, but think about it like this. You're getting paid, what, 8% now to hang out and own.
6 because they cut it, so it's about 6.25, I think, or a 6 point. Let me just check.
Hold on.
6.7. 6.7 based
Yeah,
on
okay.
today's
So
stock.
you're getting 6.7% right now, and you're getting paid monthly to
Yeah.
own creme de la creme assets in New York City that cannot be reproduced. Like one of the best people, and I'll send it to Matt so he can put it on here. Patrick Bet-David said one of the smartest things about purchasing assets that cannot be, I forget the word that he used, but it's basically
Are you talking about where he's talking about buying in the Hamptons and stuff the other day?
buying waterfront property, Mickey Mantle 1952 tops, like stuff that cannot be reproduced. Okay. These buildings in New York City cannot be reproduced because you know what? Somebody can tear down a building and rebuild an awesome building, but they're not going to build in the same position that SL Green has their awesome building in it already, in the same vicinity to subway stations and major hubs. New York City is alive and well. Forget everything on the news. Just look at straight people.
I just want to ask something really quick.
Yeah.
I think still this could be a learning moment for somebody. I still think a lot of people don't fully understand how to appropriately evaluate REITs and how it actually shows
net
up.
Income, not funds from operations.
Yeah.
Yeah.
So how do you look on a balance sheet or a cash flow statement to truly understand? Because I think most people, they'll see a very low earnings per share and the PE is so high. And so can you just walk us through, either one of you, how to appropriately value
time, but you need to go through the balance sheet and look for something that says FFO
or AFFO.
And REITs typically use AFFO. And it is their equivalent of EPS. It's the same thing as MLPs. The MLPs use distributable cash flow rather than EPS metric on evaluation. REITs are real estate. It is a much different business. There's a lot of amortization. There's a lot of depreciation on assets. Net income and EPS is not necessarily what you want to look at. You want to look at EBITDA. You want to look at FFO. And a lot of people are going to be like, Charlie Munger, EBITDA is bullshit. Well, for many companies, EBITDA is not what you want to look at, but in REITs, it's different. And SL Green is probably going to be okay. Do I know that it's going to be okay? No, but I think it probably is based on what I've.
And so what I want to finalize that, and then, I'll leave you guys for last words, exactly what Steven said. So I'm not going to devalue anything that he just said, but maybe in a crunchy sentence. The reason why people invest in real estate and invest so much capital and things like is all the tax advantages that you get. When you look at the net income statement, you're able to depreciate a lot of that. And so what you're seeing is a very low or even sometimes a negative net income, because that allows them to save on the tax piece and also get that cash flow into the business. And then as they distribute that, most of the time, you're the one that ends up paying the taxes, being a shareholder within those organizations.
Yeah, which is why you should always buy in a tax deferred account so you don't have to pay any taxes anyway. So it's like this is REITs and MLPs, especially good ones, are the perfect vehicles to put into a tax deferred retirement account because they will grow. You can just keep taking the distributions, buying more, and it's just compounder, man.
Yeah. So I just want to hit that specifically, and then I wasn't sure. I know we don't want to get into realty income today, but I'm curious if you guys.
But look, I'm reading the comments right now, and I'm not going to say anybody's name, but these are opinions. The same way I have opinions, but I can tell you, I work in Manhattan. I work in Midtown. I see what is going on. It is busy as hell.
Me too. Me too. I'm from New York
Right.
City. I work in this city. Like I literally see, yes, is there still like some weakness on Mondays and Fridays? Absolutely. The trains are not as packed. But if you're there Tuesday, Wednesday, Thursday, dude, good luck getting us like even on a train. I've had to sometimes stand there while 3L trains pass me by before I get a place to even stand on the damn thing. You know,
Yeah,
and
and
then
look,
yeah.
people are going to move out from high tax states when they have opportunities to. But
Yeah.
as of now, there is still a lot of business being done in New York. And look, you got to look at occupancy rates and then tie that to the financials. And our occupancy rates growing. And when you do that for SL Green, the investment looks compelling. And based on what they sold at the valuation, it says that the book value is legit. Right now, the book value is 59.5, and they're trading it under 45. If you just do a 1-to-1 book value, and many REITs trade at a premium to their book value, there is still upside left in this. So, I mean, I started selling covered calls at a much higher price. I have covered calls that roll off on January 19th that I sold at a 60 strike price. Pretty much doubled my monthly dividend. And
I know what's his name. Matt's been doing that too.
Yeah.
Matt's been selling covered calls
a lot. And now I'm getting too close to the sun, but I've been doubling my dividend for quite some time, and hopefully these don't get called away. I'll just roll it if it gets close. But yeah,
I mean, I was actually thinking about buying them today because I was going to try to buy them back for 3 cents a call because the last price was 5 and there was no activity, and then just rewrite them at like 55 and try to get greedy because you can double dip sometimes.
You can. I do that all the time. Google, Amazon, and SLG is no different. I mean, I'm up over 100% on the shares, or close to, if I'm not anymore. So it just doesn't make sense to not be ready to cover calls. But I got too greedy.
Yeah,
too greedy.
So, Chris, what are you looking at? What should I be looking at? I started a position in outside of my dividend harvesting series. I started a real position in Pfizer. I'm starting to start a real position in Fortinet. And I added to Tesla of all things, believe it or not, with my own money.
I'm looking at some semiconductor names that need to be corrected in terms of pricing, but once they're corrected, I think they'll provide a lot of future growth. So I'm looking at the semiconductor space, particularly
Qualcomm or Micron.
Qualcomm is the one that I'm very, very excited for.
Mm-hmm.
So I'm looking at Qualcomm like there is
people don't know about the CDMA.
We'll keep that. We'll keep that between us for now. But Qualcomm is definitely worth exploring. You know.
Yeah.
All right, boys. It was a pleasure.
Absolutely.
We gotta keep the content going, Steve. We can't let everything out in one episode, and then people won't come back. All right. We need to like slowly let it come out. Okay.
So I guess I have to watch the end of Finance Junkies, is what you said, since I didn't watch it tonight yet.
I mean, you could play it, Matt. See how I didn't even watch it yet. So why don't you put it on there?
Let's end on that.
Let's react to it. Let's react
to it.
All right, one of you pull it up. My internet's being extremely slow.
So basically, what happened was, Finance Junkies, they came after me yesterday because they love their Bitcoin. So they came after me yesterday that I was going to FOMO in. That I was going to FOMO into it. Clearly, Chris is not FOMO into things. So basically, they said, "Oh, we should give Chris some time to respond because they're making fun of me." So I said, "Okay, bad move on their part because when I come with some fire." And so let's see Chris's roast. So, all right, I'll wait till Steven gets back. So I pretty much just let him have it.
You did a good job. You weren't belligerent. You were calm, collected, and you let people know.
I could have been belligerent.
Yeah. You did a good job with it.
Yeah. So let's see if are there any companies that we want to take a look at other than the ones that we have on the pipeline?
We still owe June and many others a uranium discussion.
Yes.
And what I could do is maybe put a quick clip together of some of the uranium CEOs I've had on the channel over the past 2 or 3 years. I think it's a pretty interesting space. It's gotten cheaper. You talked a little bit about that on Finance Junkies the other day. So that's one. A lot of people are talking about Air, AEHR. I don't know if that's a Patreon exclusive or if that's something. That's
we'll keep that one.
About.
We'll keep a lid on that one for now. Air Systems. We'll keep a lid on
what
that
else
one.
was there?
Yeah. All right. Let's watch the thing. I got it pulled up. So and then we gotta go. So, all right. Just showcase this. So. But
he's been saving this.
But most of the time he just parrots whatever Vitaly says, and you know what? Like, and then hold on. There we go. But
how about New York Times? How about New York Times? Can you go there?
You're gonna have to watch a minute of this. Damn it! Shots at me. I get my shots at you, right?
You were listening.
We'll end it with a segment called The Last Word. Chris gets to have 5 minutes to say whatever the fuck he wants, and we're not going to say anything.
Which they didn't.
All right, guys, see you later.
With. Y'all asked for this. Just remember.
Go ahead, Chris. You got it.
I'll start off with Amit. Amit by far is the most clueless investor, and anyone who's been listening to him for the last year and a half. I'm sorry, bro. I'm sorry, but I am doing my best to try to educate him and actually bring some real value to Amit. All right,
he's doing a good job.
I'll say Vitaly. Carlos is pretty much Vitaly's sidekick, you know, and once in a while Carlos has his own thoughts, but most of the time he just parrots. But most of the time he just parrots whatever Vitaly says, and you know what, like, and then when Vitaly does disagree with him once in a while, it's like, oh no, Vitaly's picking on me, and it's like, bro, Vitaly picks on everybody. You know, that's just what it is, Carlos. Vitaly, you are the most myopic person ever. All you do is talk about fucking 4 categories and completely ignore everything else. You either talk about Bitcoin, Enphase, Tesla, and whatever else is the flavor of the day, just so that you feel important. You talk about all the gains that you've made, but you've never actually shown any documentation that you've actually had any gains. All you want to do is say, I'm a long-term investor and I know what I'm doing, yet you invest in the most speculative parts of the market, which is Bitcoin. And sorry to say, you know what? Anyone calls me a speculator, just look in the mirror. Just look in the mirror. You know.
There we go. The roast. There we go.
I called you a speculator?
Yeah. You said that, oh, he sells all the time. Also, you said that I would FOMO Bitcoin.
No, that's a trader. That's not a speculator.
Yeah.
Well, answer that. Do you think you're going to FOMO into Bitcoin? Because I actually defend.
All right. We'll leave it at that. But yeah.
So Steven, raw reactions.
Wow.
Don't fuck with me, dude. You come after me, you best come quick, because the king does not fucking falter. All right, just letting y'all know.
I mean,
we'll end it at that. All right, I'll see you guys. Have a good one.
Have a great weekend. Maybe I'll see you guys on a random stream tomorrow at close or over the weekend. But as always, great to see you guys on. Public portfolio ended at just under $1,500, so excited to be on there, and we'll catch back up with you guys on Tuesday. Steven, as always, great having you on. Let us know when you're available next week to talk about realty income. I'm really curious to get Chris's thoughts, but I think we got a little bit of in here anyway. But as always, we'll see you guys, and hopefully you guys have a great end of the week and have a great weekend.
Later.
Thanks all.
Take care, guys.
later.